Welcome to Books and More Audio, where great books meet powerful ideas. Here we bring timeless lessons from the world's best authors to life through clear, engaging storytelling. In this episode, we explore Personal Finance for Dummies by Eric Tyson, a classic guide that teaches you how to take control of your money, from spending and saving to investing and protecting what you have. This book isn't just about wealth, it's about freedom, helping you live smarter, stress less, and build a future of true financial independence. Assessing your financial fitness and setting goals. When I talk with people about money, the first thing I notice is that most don't have a clear picture of where they stand. They may know how much they earn or what they owe, but not what that truly means. You can't fix what you don't measure, and that's why this first part of the book is about evaluating your financial health and setting meaningful goals. Many people live from paycheck to paycheck not because they don't earn enough, but because they don't understand their financial habits. Schools rarely teach us how to manage personal finances, and families often avoid discussing it. So we grow up with mixed feelings, guilt, fear, or even denial about money. The truth is, managing your finances isn't about luck or intelligence. It's about awareness and consistent choices. The journey begins with understanding your relationship with money. Ask yourself, what role does money play in my life? Do I control it, or does it control me? Some people spend to feel happy, others save out of fear. Neither extreme brings peace. You must learn to see money as a tool, not a measure of worth, not a source of stress, but a resource to build the life you want. Next comes the practical part, measuring your financial health. Start with your net worth, everything you own minus everything you owe. This number isn't about pride or comparison, it's your personal baseline. If it's negative, don't panic, it's simply your starting point. What matters is how it changes over time. Alongside that, track your cash flow, the money coming in and going out each month. It reveals habits you didn't notice, small leaks like subscriptions, impulse buys, or dining out too often. Awareness of where your money goes is the foundation of change. Then look at your credit and debt. Credit cards can be useful tools, but only if handled with discipline. High-interest debt is like carrying a backpack of rocks while climbing uphill. The faster you drop it, the faster you'll move forward. Learn your credit score, understand what affects it, and keep it healthy. A good score isn't just a number, it's access to lower interest rates and better opportunities. Once you know where you stand, it's time to decide where you want to go. Setting goals is the most powerful step in taking control of your finances. Don't just say, I want to be rich. Define what that means for you. Owning a home, traveling freely, retiring early, or simply sleeping better at night. Break your goals into time frames. Short-term, saving for emergencies, medium-term, buying a car or paying off debt, and long-term, retirement, education, or investment growth. A key principle I emphasize is the importance of emergency savings. Life is unpredictable. A job loss, illness, or car breakdown can destroy your financial balance if you're unprepared. Aim to have a cushion that covers at least 3 to 6 months of living expenses. That fund isn't about profit, it's about peace of mind, the confidence that one setback won't ruin your future. The next step is aligning your spending with your goals. Every dollar you earn has a job to do. Some of it keeps you alive, some makes life enjoyable, and some must be set aside for tomorrow. When your spending reflects your values, not social pressure or habit, you'll start feeling in control, not deprived. But remember, money management isn't just math, it's psychology. Emotions drive most of our financial decisions. The fear of missing out pushes us to overspend. Shame keeps us from facing our mistakes. True financial growth happens when you replace guilt with responsibility. You don't need to be perfect, you just need to start paying attention and making small improvements each day. Another common trap is comparing yourself to others. You see friends with new cars, vacations, or designer clothes and feel like you're falling behind. But you never see their bank statements. You don't know if they're actually wealthy or drowning in debt. Real success is quiet stability, not loud consumption. To stay on track, review your finances regularly. Create a simple monthly check-in. Update your net worth, review your expenses, and note progress towards goals. When you measure, you motivate. Progress, even slow progress, builds momentum. In this part of the book, I also discuss the mindset shift that separates those who struggle financially from those who thrive. Taking responsibility. Stop blaming the economy, employers, or bad luck. You can't control everything, but you can control how you plan, spend, and save. Each smart decision, paying down debt, saving first, investing early, compounds over time, just like interest. Finally, understand that financial health isn't just about numbers. It's about freedom. Freedom from anxiety, from dependence, from sleepless nights worrying about bills. When you know where you stand and have a plan for where you're going, you gain confidence that no market swing or job loss can take away. So before diving into investing or retirement planning, pause and take a full look at yourself. Measure your worth, track your habits, and write down your goals. This is your foundation, the groundwork on which every other chapter of your financial life will be built. Once you know your true position and direction, every decision becomes clearer. That's what this first part is really about: self-awareness, structure, and purpose. It's not glamorous, but it's the most powerful step you'll ever take. Because when you understand your money, you begin to understand yourself. And when you master both, you're no longer chasing financial freedom, you're living it. Part 2. Spending, Saving, and Reducing Debt. When people ask me how to get rich, they usually expect me to talk about investments or the stock market. But the truth is, wealth doesn't begin with investing. It begins with managing what you already have. No matter how much money you earn, if you spend without awareness or carry high-interest debt, your financial foundation will always be fragile. That's why part 2 of this book focuses on 3 essential habits: spending wisely, saving deliberately, and eliminating bad debt. Understanding the real power of budgeting. Most people hear the word budget and instantly think of restriction or sacrifice, but I see budgeting differently. It's freedom with a plan. A good budget isn't about saying no to what you love. It's about making sure you can say yes to what truly matters. Without a budget, your money controls you. With one, you control your money. Start by tracking your expenses for a full month. Be brutally honest. Include every cup of coffee, every online purchase, every subscription you forgot existed. The goal isn't judgment, it's awareness. Once you see where your money goes, you can start redirecting it. Most people are surprised to find hundreds of dollars leaking away each month on things that don't actually make them happier. Then, divide your spending into 3 broad categories: needs, wants, and goals. Your needs, housing, food, transportation, come first. Your wants, dining out, entertainment, shopping, are optional pleasures. Your goals, savings, debt repayment, investments, are what secure your future. When you consciously balance these 3, you create harmony between today's comfort and tomorrow's security. Spending smart, not hard. To spend wisely, you must learn to separate value from habit. Before each purchase, ask, does this improve my life, or is it just noise? The people who achieve financial independence are rarely the ones earning the most. They're the ones who spend mindfully. Avoid lifestyle inflation, that quiet creep in expenses every time your income rises. Many people upgrade their homes, cars, or wardrobes the moment they get a raise, leaving them stuck in the same financial stress, just with fancier stuff. Instead, aim to live slightly below your means. When your income grows, let your savings grow faster than your lifestyle. Another simple but powerful tactic is to pay yourself first. Before spending $1 on anything else, set aside money for savings or investments. Treat your future self as your most important bill. When you make this automatic, by transferring money into a savings or investment account right after payday, you remove temptation and build wealth effortlessly. Building a savings habit that lasts. Saving isn't just about numbers, it's about mindset. Many people tell me, I'll save when I have more money. But the truth is, if you can't save a little when you have a small income, you won't save more when you earn a lot. Habits scale with income. Start small. Even $10 a week creates momentum. Open a separate savings account, ideally one that's not linked to your debit card, so you're less tempted to dip into it. Give every dollar a purpose, an emergency fund, a travel goal, or retirement savings. When you know what you're saving for, the process becomes motivating rather than burdensome. I always emphasize the importance of the emergency fund, your personal safety net. Aim for 3 to 6 months' worth of living expenses. Life is unpredictable. Job loss, illness, car repairs, these things happen to everyone. Without savings, even small crises turn into debt. With savings, they're just inconveniences. Beyond emergencies, build short-term and long-term savings. Short-term goals might include a new laptop or vacation. Long-term ones might be buying a home or retiring comfortably. Keeping these goals separate helps you stay disciplined and prevents the common trap of using retirement money for short-term desires. The truth about debt. Debt can either help you move forward or hold you back. Not all debt is bad. A mortgage, for instance, can build equity, and a student loan can increase your earning potential. But high-interest consumer debt, like credit cards or payday loans, is financial poison. It traps you in a cycle where your money works for someone else instead of for you. The first step to escaping debt is understanding how interest works against you. If you owe $5,000 on a credit card with a 20% annual rate and you only make minimum payments, it could take over a decade to pay off, and you'll pay more in interest than the original debt. That's why your priority should be to eliminate high-interest balances as fast as possible. There are 2 main strategies I recommend. The avalanche method. Focus on the debt with the highest interest rate first while making minimum payments on the rest. Once the first debt is gone, move to the next. This saves the most money in the long run. The snowball method. Pay off the smallest balance first, regardless of interest rate, to gain motivation and momentum. For some people, psychological wins matter more than mathematical ones. Whichever you choose, the key is consistency. Stop adding new debt while you're paying off old ones. If you struggle with credit cards, use cash or a debit card until you rebuild control. Using credit wisely. Credit itself isn't the enemy, misuse is. Having good credit gives you flexibility and lower costs in the long term. To maintain a healthy credit score, pay your bills on time, keep your credit utilization below 30% of your limit, and avoid unnecessary new accounts. Check your credit report at least once a year for errors. They're more common than you think. A good credit history opens doors. Better mortgage rates, lower insurance premiums, and even job opportunities. But remember, credit is a tool, not income. Don't use it to fund a lifestyle you can't afford. Balancing today and tomorrow. People often ask, should I pay off debt first or save? The answer depends on your situation, but usually it's best to do both. Build a small emergency fund first, then focus on high-interest debt while still contributing a little to long-term savings. Why? Because emergencies don't wait for debt-free days, and saving, even a little, keeps your financial momentum alive. As your debt shrinks and savings grow, something amazing happens. Your stress begins to fade. Money no longer feels like a burden. You start thinking ahead instead of constantly catching up. You gain confidence, not from luck, but from control. The mindset of true financial freedom. The ultimate goal of this part isn't just to make you debt-free or better at saving. It's to help you build a sustainable financial lifestyle, one where your money choices align with your values and give you peace of mind. When you spend intentionally, save consistently, and eliminate toxic debt, you create space, not just in your bank account, but in your life. Space for opportunities, for generosity, for freedom. That's the quiet reward of financial discipline, knowing that your future is in your hands and that every dollar you earn has a purpose. Money, when managed wisely, doesn't limit your life, it expands it. And that's what this part is all about, building habits that give you the freedom to live on your terms today and tomorrow. Part 3. Making, managing, and investing your money. When people think of financial success, they often imagine complex investments, fancy charts, or insider secrets. But true wealth doesn't come from speculation. It comes from making smart decisions with the money you already earn. In this part, I want to help you understand how income, investing, and risk work together. Once you master these fundamentals, your money will start working for you instead of you constantly working for it. Understanding how you earn. Your income is the fuel for everything else in your financial life, yet many people never take the time to optimize it. The first rule I teach is this: invest in yourself before you invest in the market. The best return you'll ever get comes from your skills, knowledge, and network. A course that raises your earning potential by 10% pays you back every single year. Still, income alone doesn't guarantee security. I've met doctors, lawyers, and business owners earning six figures but living paycheck to paycheck. Why? Because it's not what you make, it's what you keep and how you use it. Managing money wisely requires clarity. Know your after-tax income, automate your savings, and make every dollar flow toward your long-term goals. If you have multiple income streams, a job, freelance work, or small investments, track them. The more you understand your sources of income, the easier it is to build stability. And when an opportunity arises, you'll know exactly how much risk you can take without threatening your safety net. The basics of investing. Many people are afraid of investing because they think it's gambling. It's not. Investing is the art of using time to grow your money. When done properly, it's the single most reliable way to build long-term wealth. But before investing, you must have your foundation: an emergency fund, no high-interest debt, and consistent savings habits. Without that, investing becomes stress, not growth. The first principle of investing is understanding risk and return. Every investment has both. The higher the potential return, the higher the risk. There is no exception. If someone promises high return, no risk, walk away. That's a scam. You should think of investing like planting trees. You don't dig them up every week to see if they're growing. You nurture them patiently, knowing time will do its work. The market will rise and fall, but history shows that long-term investors, those who stay consistent and disciplined, always come out ahead. Diversification, the key to stability. The most important phrase in investing might be, don't put all your eggs in one basket. Diversification protects you when life or the market surprises you. It means spreading your money across different types of assets, such as stocks, bonds, and real estate. Stocks, equities, represent ownership in companies. They offer high growth potential, but also short-term volatility. Bonds are loans you make to governments or corporations. They're generally safer, but grow more slowly. Real estate provides both income and appreciation, but requires more management. When combined properly, these investments balance each other. If one declines, another may rise. That's how diversification reduces risk without sacrificing long-term return. You don't need to be an expert to diversify. Low-cost index funds or exchange-traded funds, ETFs, can give you instant access to hundreds of companies at once. They're the simplest, smartest way to invest for most people. The power of compound growth. Albert Einstein reportedly called compound interest the eighth wonder of the world. It's the process of earning interest on your interest, a snowball effect that grows faster the longer you let it roll. Here's the secret: time matters more than timing. People waste years waiting for the perfect moment to invest. But the truth is, the best time to start is as soon as possible. Even small, regular contributions grow dramatically over decades. The earlier you begin, the less you have to contribute later to achieve the same result. Think of investing as a habit, not a one-time decision. Automate it, stay consistent, and avoid chasing trends. Remember, wealth grows quietly. It doesn't shout. Managing risk and emotions. Most investors don't lose money because of bad markets. They lose because of bad reactions. Fear makes them sell when prices drop, and greed makes them buy when prices soar. Successful investing is about controlling yourself more than controlling the market. Before you invest, define your risk tolerance. Ask, how much volatility can I emotionally handle without panic? It's better to earn steady 7% returns you can stick with than to chase 12% and quit halfway. Investing is not a race, it's a lifelong journey. Another powerful tool for risk management is asset allocation, deciding what percentage of your portfolio goes to stocks, bonds, or other investments. As you age or approach major life goals, you'll likely want to shift gradually towards safer assets. Think of it like adjusting the sails of a boat. You don't change direction, you simply make sure you can handle the waves. Retirement and the long view. Retirement planning isn't just for older people, it's for anyone who doesn't want to work forever. The earlier you start, the easier it becomes. Thanks to compound growth, small contributions made early can grow into large sums over time. If your employer offers a retirement plan like a 401k or pension, contribute enough to get the full match. It's free money. If not, open your own IRA or similar account. Prioritize tax-advantaged accounts before investing elsewhere. But retirement isn't just about money, it's about freedom of choice. You may still want to work later in life, but wouldn't it be better if you didn't have to? That's what financial independence truly means, the ability to choose, not the obligation to earn. Avoiding investment traps. The financial world is full of noise, hot tips, get-rich-quick schemes, and overconfident influencers. I've seen people lose fortunes chasing trends they didn't understand. To protect yourself, remember 3 rules. If it sounds too good to be true, it is. Never invest in something you don't understand. Ignore daily market headlines. Focus on long-term fundamentals. Also, beware of excessive trading. Every transaction has costs in fees, taxes, and stress. Real investors build wealth slowly and calmly. Speculators chase excitement and usually lose. Investing isn't just for the rich. Many believe they need thousands of dollars to start investing. That's a myth. With today's tools, you can begin with small amounts. What matters most is consistency, not size. The habit of investing, even $50 or $100 per month, trains your mind to think like a wealth builder. If you invest regularly, diversify wisely, and stay patient, your future self will thank you. The earlier you start, the more freedom you'll earn later. Freedom to travel, to give, to live life on your own terms. The real goal. The ultimate goal of managing and investing your money isn't to become the richest person in the room. It's to gain peace of mind. Money should serve you, not dominate you. When you know your goals, manage your spending, and let your investments grow quietly in the background, you create a life built on security, not anxiety. So as you move through this part of the book, remember, investing isn't about beating others. It's about building your own future. Don't rush, don't panic, don't compare. Build your wealth patiently, wisely, and purposefully. Because in the end, financial success isn't measured by how much you earn. It's measured by how confidently and freely you live. Part 4. Protecting what you have. Over the years, I've met many people who spent decades working hard, saving, and investing, only to watch it all disappear because of one unexpected event. A car accident, a house fire, a serious illness, or even a lawsuit can wipe out everything you've built. That's why this part of the book focuses on something people often overlook: protection. Building wealth is important, but keeping it is essential. Insurance isn't about fear, it's about peace of mind. It's your financial safety net when life throws you a curveball. Why protection matters. People don't like talking about insurance. It feels boring, complicated, and worst of all, it reminds us of risks we'd rather ignore. But the truth is, no financial plan is complete without it. Saving and investing without insurance is like driving a car without seatbelts. You might be fine for years until one bad day changes everything. The goal of insurance isn't to eliminate every small inconvenience. It's to protect you from financial disaster, the kind that could force you into debt or destroy your long-term goals. Think of it as a transfer of risk. You pay a small, predictable amount, the premium, so that the insurance company bears the cost of a big, unpredictable loss. Rule number 1. Protect the big things, not the small ones. One of the first lessons I share is simple. Don't insure the little stuff. You don't need insurance for your phone or toaster. You need it for your health, your income, your home, and your ability to provide for your family. If losing an item would merely inconvenience you, you probably don't need insurance for it. But if losing it would devastate your finances, you do. That's the dividing line between smart coverage and wasteful spending. Rule number 2. Protect what you can't replace. Money can buy a new car or repair a roof, but some things are irreplaceable. Your health, your ability to earn income, and the well-being of your loved ones. That's where life, health, and disability insurance come in. Life insurance isn't about you. It's about the people who depend on you. If you died tomorrow, would your family still have income to pay the mortgage or send the kids to school? If not, you need life insurance. For most people, term life insurance is best. It's straightforward, affordable, and designed to cover you during your working years. Don't confuse insurance with investment. Products like whole life or universal life mix the two, often with high fees and low returns. You're better off buying term insurance and investing the difference elsewhere. Disability insurance is one of the most underrated forms of protection. You're far more likely to become temporarily or permanently disabled than to die young. Without this coverage, one accident or illness could end your ability to earn. A good disability policy replaces a portion of your income if you can't work, giving you time to recover without financial panic. And of course, health insurance is critical. Medical costs are one of the leading causes of bankruptcy. Even a short hospital stay can cost tens of thousands of dollars. Choose a plan that fits your needs, but remember, lower premiums often mean higher deductibles. Pay attention to what's covered and make sure you can handle the out-of-pocket costs if something happens. Rule number 3. Protect your property and assets. Your home, your car, and your possessions represent years of effort and investment. Homeowners or renters insurance shields you from losses due to fire, theft, or natural disasters. Make sure your policy covers replacement cost, not just the current market value. Rebuilding a home costs more than most people expect. When it comes to auto insurance, don't skimp on liability coverage. Many drivers buy only the minimum required by law, but that's often not enough to cover serious accidents. If you're found at fault, your personal assets could be at risk. Always choose higher liability limits to protect yourself. For those who own valuable assets or have significant income, consider an umbrella policy. It's an extra layer of liability protection that kicks in when your other policies reach their limit. It's surprisingly affordable and can save you from losing everything in the event of a major claim. Protecting your future and legacy. Insurance isn't just about emergencies, it's also about long-term planning. That includes estate planning, or deciding what happens to your assets after you're gone. Start with a will. It ensures your property is distributed according to your wishes and prevents family conflicts. If you have dependents, name a guardian. For more complex situations, like owning property or a business, a trust can help you manage assets, reduce taxes, and avoid probate. I also recommend creating powers of attorney for finances and healthcare. These legal documents let someone you trust make decisions on your behalf if you're ever unable to do so. It's not a pleasant topic, but preparing early protects both you and your loved ones from chaos later. The claims process, getting what you paid for. Having insurance is one thing, getting it to pay when you need it is another. Insurance companies are businesses. They profit by paying as little as possible. To make sure you get what you're owed, document everything. Keep receipts, take photos, and record every conversation. File claims promptly and follow up regularly. If a claim is denied unfairly, don't give up. Ask for an explanation in writing, escalate it to a supervisor, or contact your state's insurance regulator. You paid for coverage. You deserve the protection you were promised. Protecting against scams and false security. The financial world is full of products that sound like insurance but offer little real protection. Overpriced extended warranties, accidental death policies, or investment-linked insurance with hidden fees. If you don't fully understand how a policy works, walk away. A legitimate policy should be simple. You pay a premium, and in return, the insurer covers specific risks. Always buy from licensed companies with strong financial ratings, and never make decisions under pressure. If a salesperson is rushing you, that's a red flag. Peace of mind is the real payoff. Many people think insurance is about preparing for disaster, but I see it differently. It's about creating stability, knowing that, no matter what happens, you and your family are protected. That peace of mind allows you to live more fully, to take reasonable risks, to build and enjoy the wealth you've worked for. Remember, financial success isn't just about accumulation, it's also about preservation. Protecting what you have is not optional, it's the foundation that supports everything else. You don't buy insurance because you expect tragedy. You buy it because you believe your life and your future are worth protecting. And when you understand that, you'll see insurance not as an expense, but as an act of love for yourself, your family, and the future you're building. Part 5. Finding financial help and reliable guidance. By the time you reach this point in your financial journey, you've learned how to earn, spend, save, invest, and protect your money. But even the most disciplined person eventually faces a challenge that feels too big to handle alone. A confusing investment decision, a complex tax situation, or the question of how to retire securely. That's when knowing where to turn for help becomes just as important as knowing how to manage your money. This part of the book is about finding trustworthy advice, using technology wisely, and learning to filter out the endless noise that fills the world of finance today. Let's start with financial advisors. Many people assume that hiring one automatically guarantees smarter decisions and higher returns. Sadly, that's not always true. The financial world is full of so-called experts, and not all of them have your best interests at heart. Some are simply salespeople wearing a professional title, earning big commissions from the insurance policies, funds, or investment products they sell. Their goal isn't to make you wealthy, it's to make themselves wealthy. That's why I always remind readers, before you hire anyone, make sure you understand how they get paid. A trustworthy advisor should be transparent and happy to answer questions. The best ones are known as fee-only planners. They charge a flat or hourly rate for their advice, rather than taking commissions from what they recommend. They work for you, not for a financial company. When you meet an advisor, ask clear questions. Are you legally required to act in my best interest? How are you compensated? What credentials do you hold? What's your investment philosophy? And how do you measure success? If they can't explain their answers in plain English, that's a warning sign. Good advice should make you feel smarter and safer, not confused or pressured. Remember, if someone rushes you into a decision, walk away. There are no emergency investments. You don't need an advisor for everything. Most of what truly matters, budgeting, saving, reducing debt, and investing in simple index funds, you can do yourself. But there are moments when professional guidance is worth the cost. For instance, if you're preparing for retirement, receiving an inheritance, selling a business, or managing complex tax issues, a qualified planner or accountant can help you avoid costly mistakes. Think of them not as people who control your money, but as coaches who help you make better decisions. The key is to stay in charge. Even if you hire help, never hand over complete control without understanding where your money goes. Beyond advisors, we now have something previous generations didn't: technology. Financial apps and online tools can turn what once felt overwhelming into something simple and even enjoyable. Today, you can track every expense automatically through apps like Mint or YNAB, which categorize your spending and help you see exactly where your money is leaking away. For investing, robo-advisors like Vanguard, Fidelity, or Betterment can build and manage a diversified portfolio for you, using algorithms that adjust your investments as markets change, and at a fraction of the cost of traditional advisors. For taxes, software such as TurboTax or H&R Block makes filing easier and ensures you don't miss valuable deductions. The best part of these tools isn't convenience, it's clarity. They strip away emotion and give you data, helping you make decisions based on facts, not feelings. But technology is a double-edged sword. The same internet that gives you access to powerful financial tools also bombards you with opinions, predictions, and false promises. Every day, someone online claims to have discovered a new secret to getting rich. You'll see flashy cars, crypto gurus, and trading experts promising guaranteed profits. Don't fall for it. Real financial success is never built overnight. It's built quietly through discipline, patience, and understanding. The best way to protect yourself is to become a careful consumer of information. Ask, is this person trying to teach me or sell me something? Does their advice make sense, or does it sound too good to be true? Do they have evidence to back their claims, or just stories? Reliable information is out there. You just need to know where to look. Trusted sources like the Wall Street Journal, Kiplinger's Personal Finance, Forbes, and Morningstar offer balanced insights and research you can depend on. And of course, never underestimate the value of timeless books. I always recommend The Millionaire Next Door by Thomas Stanley for its lessons on modest living, Your Money or Your Life by Joe Dominguez for understanding the connection between money and purpose, and The Intelligent Investor by Benjamin Graham for long-term investing wisdom. Reading builds financial confidence the same way saving builds wealth, slowly, steadily, and cumulatively. As you grow more confident, remember that managing money doesn't have to be a solitary task. Talk about finances with your partner, family, or trusted friends. Too many households treat money like a secret, and that secrecy breeds fear and mistakes. When you make money an open, honest topic, it becomes less intimidating and more empowering. If you're in a relationship, both partners should understand the family finances, income, savings, debts, and insurance. If only one person handles everything, the other is left vulnerable if something goes wrong. Financial transparency strengthens relationships, it doesn't weaken them. Even with all the knowledge and tools in the world, you'll never have every answer, and that's okay. The most successful people I've met aren't the ones who know everything, they're the ones who never stop asking questions. Before signing any agreement, investing in anything, or taking financial advice, always pause and ask, do I understand how this works? What are the risks? How does this move me closer to my goals? If you can't answer clearly, don't proceed until you can. Curiosity protects you better than any insurance policy. The ultimate goal of this part isn't to make you dependent on professionals or apps. It's to make you independent through understanding. Advisors, books, and tools are there to guide you, but you are the one steering the ship. You are the CEO of your financial life. The more informed you become, the less power fear and confusion have over you. You'll be able to recognize bad advice immediately, avoid scams confidently, and make decisions with calm assurance. When you know how to find the right help and filter the noise, money stops feeling like a mystery. You start to see it clearly, not as something unpredictable or intimidating, but as a system you understand and control. And that's the real freedom this part is about. The freedom to make financial choices based on knowledge, not anxiety. To seek help when you need it, but never depend on anyone blindly. Financial independence isn't just about having money, it's about having confidence. And that confidence begins the moment you decide to take charge of your own financial story. Part 6. Timeless Financial Wisdom for Life. As we reach the final part of this book, I want to remind you that personal finance is not just about numbers. It's about choices, values, and peace of mind. You don't need to be a genius, and you don't need to chase perfection. What matters most is developing habits that last, habits that keep you steady when the economy shakes and calm when everyone else panics. In this last section, I share the essential lessons, 10 core ideas that have guided not only my career, but also thousands of people I've worked with. Think of these not as rules, but as a compass for life. The first truth is simple. Financial freedom begins with awareness. You cannot fix what you don't understand. Many people avoid looking at their finances because it feels overwhelming or depressing, but ignorance is far more expensive than honesty. Knowing where your money goes, every dollar in and every dollar out, gives you power. It may not feel comfortable at first, but clarity always leads to control. Awareness turns fear into action. The second truth, live below your means, but within your joy. Frugality is not about deprivation, it's about direction. Spend intentionally on what brings meaning, not on what brings momentary excitement. Every dollar you don't waste becomes a building block for your future. The most financially secure people I know aren't the ones with the highest incomes, they're the ones who consistently spend less than they earn. They enjoy life, but they do so on their terms, not society's. Third, eliminate high-interest debt as soon as possible. Debt steals your time, your peace, and your future choices. It's not just about money, it's about freedom. When you owe less, you sleep better, think clearer, and make better decisions. If you have debt, tackle it with focus and discipline. Don't see it as punishment, see it as the price you pay for freedom. The fourth principle, build an emergency cushion. Life will surprise you, that's guaranteed. The question is whether you'll be ready. An emergency fund is not about earning interest, it's about earning confidence. Knowing you can handle a crisis without debt changes the way you see life. You stop living in fear and start living in stability. Fifth, invest early, consistently, and patiently. The miracle of compound growth doesn't reward the smartest investor, it rewards the most consistent one. You don't have to time the market, you just have to give your money time in the market. Even small, regular contributions can grow into something extraordinary. Investing is not gambling, it's long-term ownership of the economy. The sixth truth, protect what you build. All your effort means little if you lose it to a disaster, illness, or accident. Insurance may not feel exciting, but it's the foundation of every solid financial plan. It ensures that one bad day doesn't undo years of good work. Health insurance, life insurance, disability coverage, these are not costs, they are shields. The seventh principle, keep learning. The financial world changes constantly. Tax laws shift, new technologies appear, and investment products evolve. The people who succeed are not those who memorize facts, but those who stay curious. Read books, listen to experts, question trends, and seek truth over popularity. Knowledge compounds, just like money. The more you learn, the more confident you become, and the less likely you are to fall for scams or hype. Eighth, plan for your future self. Retirement is not just a distant dream, it's a phase of life that deserves preparation. Picture the life you want to live and start creating it today. The earlier you save, the easier it becomes. You're not saving for old age, you're saving for freedom. The freedom to choose what to do with your time. The ninth truth, don't compare your path to others. In the age of social media, it's easy to feel behind. You see your friends buying houses, cars, vacations, or designer clothes and wonder if you're missing out. But you don't see their credit card bills, their loans, or their stress. Comparison kills contentment. Focus on your own progress, small, steady steps forward. Real wealth is quiet. It doesn't need to be shown off. And finally, the 10th and most important lesson. Remember why you're doing all of this. Money by itself means nothing. It's what you use it for that gives it value. The purpose of financial freedom isn't to hoard wealth, but to live intentionally. To have the freedom to spend time with the people you love, pursue what excites you, and give back to causes that matter. When you see money as a tool for meaning rather than status, it becomes something empowering, not stressful. At this stage, I hope you see that personal finance is less about mastering complex systems and more about mastering yourself. The principles are timeless because they're based on human nature, discipline, patience, and balance. Wealth doesn't come from luck or secret formulas, it comes from consistency. Doing the right things, even small ones, over and over again. So as you close this book, I want you to remember, financial success isn't about having more. It's about needing less and choosing wisely. It's about the peace that comes when you know you're prepared, protected, and free to live on your own terms. You don't have to be perfect, you just have to begin. Every step, every decision, every dollar aligned with your values moves you closer to the life you truly want. Money can't buy happiness, but it can buy freedom. And freedom is the foundation on which happiness can grow. Keep learning, keep saving, keep giving, and most importantly, keep perspective. Because in the end, being rich isn't about how much you have. It's about how wisely, calmly, and meaningfully you use what you have. And that, above all, is the essence of financial finance done right.